Hi everybody, welcome back to the exam number 2 study guide videos. In this video we'll start working on question number 9. On August 1st, 20X1, Rocket Retailers adopted a plan to discontinue its catalog sales division, which does qualify as a separate component of its business according to GAAP. The disposal of the division was expected to be concluded by June 30th, 20X2. On January 31st, 20X2, which is Rocket's fiscal year end, the following information relative to the discontinued division was accumulated. The discontinued division had an operating loss for the year ended January 31st, X2 of $115,000. It has expected operating losses from February 1st to June 30th, X2 of $80 million. And there were impairment of division assets at January 31st, 20X2 of $10 million. In its income statement for the year ended January 31st, 20X2, Rocket would report a before-tax loss on discontinued operations in what amount? Please calculate Rocket's before-tax loss on discontinued operations. Then start the video again to check your work. Did you calculate a before-tax loss on discontinued operations of $125,000? This one was a relatively straightforward problem. The only kicker that they tried to get you with in this problem is this estimated loss for a future period of time. You don't need to record an estimated loss for a future period of time. So the calculation is the operating loss for the current year end, which was $115,000, and impairment of division assets during this time period, or as of this date, $10,000 for a total loss before tax of $125,000. Question number 10. On May 1st, Foxtrot Company agreed to sell the assets of its footwear division to Albanese Inc. for $80 million. The sale was completed on December 31st, 20X1. The following facts pertain to the transaction. Footwear division qualifies as a component of Foxtrot according to GAAP rules. The book value of Footwear's assets totaled $48 million at the date of sale. So they sold the assets for $80 million on December 31st, and the net book value of those assets on December 31st was $48 million. Footwear's operating income was a pre-tax loss of $10 million, and Foxtrot's income tax rate is 40%. In the income statement for the year ended December 31st, 20X1, how much income or loss from discontinued operations would Foxtrot report? Please pause the video, do your calculations, then start the video again to check your work. Did you calculate an income from discontinued operations after tax of $13.2 million? That is calculated as follows. Proceeds from the sale of assets is $80 million, less the book value of those assets at the date of sale of $48 million. Leaves a gain on the sale of assets of $32 million less the operating loss from that division of $10 million for the year ended 20X1, calculates income from discontinued operations before tax of $22 million, less income tax calculated at a rate of 40%, $8.8 million, leaves income from discontinued operations after tax, $13.2 million. Okay, I think that it's time to have some more scavenger words. The scavenger words for this video are when you were growing up. When you were growing up. I will award 5 bonus points to the first 25 students who send me a Canvas message with the following information before the due date of exam number 2. Please send me the entire question. Please send me your answer to the question and give me a brief explanation or example of why you chose that answer. Okay. The next 2 questions in this video relate to Misty Company. And Misty Companies reported the following before tax items during the current year. Sales revenue of $600, selling and administrative expenses of $250, restructuring charges of $20, and loss on discontinued operations of $50. Misty's effective tax rate is 40%. What is Misty Company's income from continuing operations? Please pause your video and calculate Misty Company's income from continuing operations. Then start the video again to check your work. Misty Company's income from continuing operations after tax is $198, calculated as follows. Sales revenue of $600 less selling and administrative expenses of $250 and restructuring charges of $20 equals net income from continuing operations before tax of $330. The income tax rate is 40%, so tax is $132, leaving income from continuing operations after tax of $198. So still using this information here, please pause the video while you calculate Misty's net income for the current year. And that, of course, would be an after-tax net income. Then start the video again to check your work. So we already calculated Misty's income from continuing operations after tax of $198. We can start out with that and then address the loss on discontinued operations. So the loss on discontinued operations is $50. But by deducting that loss, we're going to reduce our income tax. So less a tax benefit at a 40% rate of 20 leaves $30 million loss from discontinued operations net of the tax benefit. Subtract that from their income from continuing operations and you calculate bottom line net income after tax, $168. Well, that's all for this video. See you next time.